In this presentation, we will continue on to part number 15 of our C Corporation Comprehensive Problem, this time taking a look at an M1 related to bad debt expense. Here is our Form 1120, and we have the bad debt expense, which is going to be part of the income statement. Let's jump on over to our Excel worksheet to think about the bad debt expense, and we are in tab number 15. We have the bad debt expense down below, which we have highlighted. And the other side of the bad debt, we're going to put into the M1 adjustment, which is down here, to the bad debt M1 adjustment. Now, why might we have a bad debt adjustment? Just a quick recap on what bad debt is a result of. And there's two methods that you can use to record the bad debt. So, and we do have a course on that. That's more of an accounting type of topic than the data input topic here. So that would be in the corporate accounting kind of issue. But that's going to be the accounts receivable up top. Remember, is on the books at the $650,000, and then we're going to assume that some portion of that isn't going to be collectible, or we know that we're not going to get paid at some point. And what happened when we record the accounts receivable? We know that we increased the receivable and increased income down here. So what happens when someone doesn't pay us? We kind of increased income, and we shouldn't have, because we didn't really make a sale, because we're never going to get the income, and that's what a sale usually means, because we want to get cash for it. So then you would think we'd have to reverse that, decreasing sales, but we don't typically decrease sales. Instead, we're going to make this bad debt expense, so the expense goes up rather than the sales going down. However, we can't really, if we wait until the thing becomes uncollectible into the future, then the timing difference, the matching principle, the accrual principle will have a problem, and therefore, it won't match up properly. Therefore, generally accepted accounting principles typically don't let us use what's called the direct write-off method, which would basically wait until something is uncollectible, but would rather have us use the allowance method, which results in us trying to estimate how much of the bad debt we think is uncollectible, and then put a contra asset account on the balance sheet to reflect that. And then as we record that allowance, we'll record the bad debt expense. So it could be the case then that we have a situation where some of the bad debt expense isn't allowed due to the estimated nature of the bad debt expense if using the allowance method, and that could result in an M1 adjustment. So let's just analyze what that M1 adjustment might look like. If we determine that the bad debt expense we have in our notes down here, that $5,000 of it is uncollectible, we're going to enter an M1 related to that adjustment. So I'm going to go back up top. We're gonna enter that into the tax return first. So I'm gonna go over to the tax return, and we're gonna say, okay, well, where is it at this point in time? Where's that bad debt expense? It's gonna be under the statement number 2, where we had, actually, it's not under statement number 2. It's right here, number 15. Bad debt expense at the $20,000, and then if we go to page 6, we're gonna have an adjustment for bad debt expense. So we're gonna be down here under number 5 on the M1s, we're going to jump to these statements so we can add our bad debt expense. We're going to I'm going to right click and jump to. So we don't have anything that's pre-designated for the bad debt expense. Therefore, we're going to go down to the bottom and add it to other. So I'm going to go into other. I'm going to say bad debt expense. And that was for $5,000. $5,000, I'm going to say okay. Then we're going to go back up top. See if that shows up where we think it would. Right there, it's in the statement number 7. There's our $5,000 in the bad debt expense. If I close this then, back out, scrolling back up, does that throw us out of balance? It does. That's what we would expect because we haven't adjusted the other side being on page 1 of the 1120. Back up top to page 1 of the 1120. So we want to be in the bad debt expense, which is currently at the $20,000. I'm going to go ahead and jump to that data input by right-clicking. Go into the jump to the data input. We're going to go to the bad debt, and within that bad debt, I'm going to show the M1 in the detail. So underneath it, I'm going to call this an M1 so we can kind of see our journal entry as we do this. I'm going to put a negative $5,000 to bring that down to the 15, 20 down to the 15. Then we're going to go back up to the forms, back to the forms. There's our 15,000. Let's now go to page 6 and say, hey, does that put us back in balance on the Schedule L, the balance sheet? Scrolling down, we're going to say it does indeed. So now we want to see if we can reflect that in our Excel worksheet. See if we can make a nice transparent reflection of that in the worksheet. It's going to be T for tax journal entry as opposed to an A, which I'm using for adjusting journal entry. We're going to make a note for it. We're going to say this is an or let's call it an M1. M1 for bad debt expense. All right. So let's go ahead and record that. We're going to be debiting the bad debt expense M1 down here and crediting the bad debt expense up there. So I'm going to say equals and scroll on down to that bad debt M1. And then we're going to be underneath it, we're going to be picking up the bad debt here. So there's going to be our journal entry. The amount is going to be for $5,000, which of course will be both the debit and the credit. So there's going to be our journal entry. Let's go ahead and post this out, see what happens. We're going to post the M11 first. So I'm going to scroll down to the M11 and we're going to go to Q50. Within Q50, I'm going to say equals, scroll to the left, scroll to the top, not to the top, but up. And then I'm going to pick up that 5,000. There's the 5,000. And then we're going to say the other side is going to be in the credit to that green bad debt. So it's in Q30 equals. We're going to pick up that credit to 5,000, bringing the balance down to that 15,000. Scrolling back down, let's check our end numbers down here. See if these tie into what is on the tax return. You'll recall, of course, that the book balance still picks up the whole column, whereas the tax does not, because it's not picking up the M1 adjustments. That's the difference. Let's see if we see that on our statement here. Let's first start at the first page of the 1120. We see a change to this number. We see the 15,000 up here. We already saw that 15,000. Let's check it one more time just to look at it again. So there it is. It looks like that has done what we expected it to do. And then we have the 1685629. So that's 1685629. That looks good for the tax side of things. Let's go on down to page number 6. So here's page number 6. We're still in balance. That's good news. That makes us feel good. And then we have the book balance at the 1461500. So there's the 1461500. The other side then at the 1685629. That's the 1685629. So that looks good. Of course, the difference being, in this case, the 5,000 in the note. There's the 5,000 there. That's being included in our M1 adjustment down here as well.